Alrighty. Hey team. Thank you guys all so much for joining us this evening. Greg and I are, as always, super excited to talk about the things that we geek out on, which are interest rates, OCR, reviews, loan structures, lending policy, and the market. So we're going to cover that off sort of in probably about half an hour, 40 minutes. Heaps time to ask questions if you've got any. And yeah, if any of you who are popping in now, that is all good. Please just pop your hand up and pop a question into the chat box if you have anything. Just a very quick overview. So Greg and I are both mortgage advisors here at My Mortgage. For those of you who haven't met with us before or don't know who we are, we are a mortgage advice firm with about 15 in our team, got some incredible people, and very excited to be helping a lot of people at the moment with first homes, investment properties, and a lot of advice around structures and getting the right interest rate fit. So, with the OCR review last week, kind of a bit of a drop, we just wanted to kind of cover off a few things and a couple of quite key questions that we're getting. So to start off with, Greg is going to give us a little bit of context. Thanks, Greg.
Thanks, Claire. Yeah, welcome everyone. It's good to be with you. And as Claire said, these are the things that we love chatting about. So it's cool to be able to do that in a group setting. So yeah, we had a update to the OCR, I think 20th of August, and the OCR dropped by 0.25. So 25 basis points if you listen to the economists and how they talk about it. And that's down to 3%. So this is where most economists thought we might get to. If they were talking 12 months ago, this is kind of the number that they thought we would get to. We've obviously got there, and the indication, if we just kind of jump down to that trajectory, the indication is that we're probably going to see two more cuts within the next 6 months, so by Q1 of 2026. So we're going to talk a little bit about what that probably means moving forward. But all of that to say, the economy is probably not doing as well as people would have hoped. The inflation numbers are back down within that range, so the 1 to 3% range, which is where the Reserve Bank needs to get them to, which is great. But we still haven't quite seen the economic pickup that they were hoping for. So, in terms of from a global point of view, the economy in general globally is in an interesting place. The share markets in the US are doing really well. There's been some really massive bounce back, especially in the second half of the year. We do still have a global leader who sometimes likes to make some decisions quite quickly that can have some pretty significant effects on the markets. And so, yeah, Donald Trump's tariffs can have an impact. And so we're pretty realistic that things can change quite quickly. So obviously all the advice we're giving today is kind of general advice, really important to get independent advice, but noting that the global economy is a little bit probably fragile would be the word, and a lot of change is kind of happening and coming. So we've seen after the OCR announcement, we've seen changes to the 1 to 5 year rate. So all of our fixed rates, the 6 month actually, the 5 year rate. We'll jump on the next page in a second. We'll talk through what those actually are, and they're down to lows that we haven't seen probably since about the end of 20 or start of 2022, somewhere around there when rates
Mm.
started to go back up. So the next OCR review is on the 8th of October. So we've got about 6 weeks, 7 weeks until that update. One of the things to note with the OCR updates is that the Reserve Bank's actually working off data that's 3 months old. So in New Zealand, we only do all of our main data analysis every 3 months. And so it's 3 months ago that we're working off that data. So in a month's time, we'll have some slightly newer data, but it's still 3 months old. So we're a little bit behind the eight ball, unfortunately. So it'll be interesting to see where we get to there. So if we jump to the next slide, and Claire's going to just chat through these rates and where we see them at the moment.
Yeah, cool. Thanks, Greg. So, this is a little bit of a general overview of rates, so a bit of an average across all of the mainstream banks. Some of the 6 month and probably those two at the bottom, the revolving credit and offset. Some of those it could be a little bit different depending on the lender. But broadly, 6 months to 5 years is pretty consistent across the board. We've seen a drop in that 1 year by a little bit. Most of those 3 or 4 weeks ago were at about 479. The 2 year rate has probably like dropped a bit more than that. So starting to kind of now be pretty consistent across 1 and 2 years. The 3 year rate is really interesting, and I was just speaking to some clients actually talking about splitting a relatively large amount of lending. Um, and just kind of explaining a little bit about that 3 year rate now, dipping below 5% is starting to become quite a bit more attractive. And interestingly, about 3 or 4 months ago, there was a 4.99% for 3 years. Then it went back up again and now it's back down. So a few people jumped on that when it happened. But I think 3 years at 4.95 is a very attractive rate. And I think a lot of us have actually been waiting for that 3 year part to sort of drop below that 5% threshold. 4 and 5 are still kind of pushing out a little bit. And I think that that still gives a bit of an indication that banks are not thinking rates are going to stay low forever. They are pricing in a slight increase within that sort of 5 year period. So thinking about that and thinking about those people who traditionally might be doing the 1 and 2 year fixes, kind of considering maybe that what I'd call a mid-range, a 2 and 3 year at the moment, just to lock in a little bit more certainty, particularly if you've got a reasonable amount of lending. We generally don't say, a smaller amount of lending split across a bunch of different loans, but when you do have a 500k plus, doing a little bit of splitting of risk is quite good. And as Greg talked about, sort of that 1 year rate at 475, 474, but also the trajectory kind of heading down slightly as well. We might see those starting to hit kind of the mid fours early next year, even potentially towards the end of this year. But we just don't think there's going to be huge, significant drops between now and then. Because what sort of happened in the last few reviews is what I've sort of called the law of diminishing returns, because the banks have started to price in these OCR drops because they're expected. And so, for example, with this last one at 0.25%, we've actually only had about 0.05 off some of those fixed rates. So the returns in terms of rate drops are diminishing a little bit. However, the floating rate is now dipping sort of below that 6% range, which is nice. So for anyone who wants a bit more flexibility, or they might be building or have a bit else going on, that's really useful. Oh,
So one of the questions we get asked a lot is how to decide which rate to go on. And as Claire mentioned, there's a lot of a lot of reasons why you might be on one rate or another. And one thing I say to my clients, especially my first home buyers all the time, is just because your mum and dad or brothers and sisters or friends from work have their home loan structured in a certain way, doesn't mean that you need to do the same as well. So few things to consider. So changes in your situation. I was just having a conversation with a client earlier today about looking to start a family. And so that's a really good reason to fix for slightly longer term, just to give you that little bit more certainty if the rates kind of indicate that that's the right thing to do. Maybe your income is increasing, so a change in role, or your business has got a big contract coming in or something like that, then there's a different rate that might make sense to go on. If you're selling or looking to buy another property, there's really good reasons there that potentially a shorter term, or lining up your sales process. So, for example, I'm personally selling my property at the moment. I've just been jumping on 6 month rates for the last probably year as we've been trying to figure out what we're doing. We don't want to come to sell our property and have a 3 year fix and be left with large break fees because of that. So some of those things might come into play as well. As Claire mentioned, sometimes a floating rate is the right way to go. There's a whole bunch of reasons that might be right for you. One thing we just note though is we've had a few people, as rates have been coming down, where they've been on a floating rate waiting for that next OCR drop, and then that next OCR drop comes, and there's another OCR announcement in 6 weeks' time, and that, oh, I'll just float until that as well. And all of a sudden, we've been floating for 3 months, potentially paying 1.5% more than we could have got for a 6 month rate, and we've lost all the benefit of that. So it's just something to be aware of. There's that fear of missing out, that FOMO, that if I jump on this rate now, in 3 months, I might look back and it might be not the best rate. We often talk about once you've decided, we've made that decision, you've locked in your rates, put those blinkers on, not look around and get rate envy too much. Obviously, if there's a really good reason, we can look at break fees and all those sorts of things. Does it actually make sense? But once you've committed to that, it's kind of okay, cool, this is where we are, regardless of what happens with rates. We made the best decision with the best information we had at the time, and now we've just got to move on forward with that. Obviously, different loan products, all the banks have different types of loans, whether it's an offset facility, a revolving credit, things like that. And so considering that, and also refinancing options, we are actually seeing at the moment a bunch of clients where refinancing to a new bank, maybe extending loan terms, or maybe just to get onto a cheaper rate, getting a new cash contribution, things like that is actually a really good option as well. In terms of like what's coming in the next 1 to 3 years, as Claire mentioned, we do think that those rates are going to come down a little bit more, maybe to those 4.5%, and in those shorter term rates. And then most people are indicating that the rates will go up again. We think that not massively, not to the 7.5s that we had at one point, but that the rates are going to creep up a little bit. And we expect, and we're going to talk in a second about the market and what's happening with house sales and all those sorts of things. We do expect that to start to pick up, and then that means rates will probably go up as that inflation maybe starts to creep up, and we just want to put that damper that back down a little bit. So there's a few of the things in terms of how to decide what rate is going to be best for you.
So another thing that Greg and I often talk about with our clients is, what are you actually doing to take advantage of cheaper rates? So we've actually seen the best part of nearly 3% drop off from the peak of rates, and some people are actually getting into some pretty big savings. And there's still about $200 billion worth of lending due to refix in the next 6 months. And for us, that's actually a really big opportunity to make a whole lot of progress on your lending. Now, that might not be exactly the same for everyone. So my question there around, what does that look like for you? It might be something like, hey, my repayment's dropping by, gosh, it could be $100 to $150 a week, but we're actually going to use $50 a week of that and keep that repayment at that level to continue to make more progress on our home loan. That's a really good example of how you can still use those slightly lower costs of lending to make a little bit more progress. And you'll be really surprised, and when you start to look at loan terms and things like that, which we often do for clients, is how much that actually saves you over the long term. So most people do take a 30-year loan term when they first start their home loan or their mortgage. And what that does is it means that that's sort of the maximum amount that you're going to pay across that 30-year period. But the more you pay in principal, or the more you pay above the minimum repayment, the shorter term or shorter time it takes you to pay off your loan. So probably our questions are around, where will you channel your savings? And this is a bit of an example here of what that could actually look like. This is a real example of a client that we've been dealing with in the last couple of weeks. So their existing interest rate at 6.49, on $600,000 of lending. The new rate they're looking at fixing for 2 years at 4.75%. It's nearly $150 a week in saving that they could actually basically chunk off their loan, and that could be a 5 or a 10-year drop off their loan term. So there's a big number there, that's 7,748, or mid 7 sevens, and that's a decent amount of money. So just thinking about what you're doing with that, it's not just like, yay, our repayments dropped. Totally take the win. Don't get me wrong. I know things are expensive, but if there is a way that you can even just allocate a third of those savings back towards your home loan, you are going to make a lot more progress quicker.
Yeah, and as Claire mentioned, what I've been talking to a lot of my clients about is going, ideally we want to keep in that situation that 150 a week. If we can keep that going onto the home loan, awesome. That means you're making huge progress. But going, hey, it'd be nice to have a little bit of money in our back pocket because cost of living is so high. So let's go meet halfway. $75 a week. We'll keep paying more than minimums, but 75 a week we're going to drop back into our kind of weekly spending or whatever. So it's just being smart about what we do there as well. Cool. So a little bit of a market overview. And just to note, like we're obviously not real estate agents. We're not right on the front line in terms of at open homes. Although because I'm selling my house, I seem to have an open home well, I do have two open homes every weekend. But also we're in conversations with agents and solicitors and accountants and those people all the time, lots of our referral partners. So there is increasing numbers at open homes. So I happened to go to another open home on the weekend, and there were 17 groups walking through a investment property, first home kind of level property. So the agents were obviously very happy with that. But interestingly, sales volumes are lagging, so they are down. And talking to some solicitors today as well, they just said, "Hey, look, June felt fairly busy, and then July and August has just been a little bit slower, and that's the general feeling that we're getting as well." However, and this seems kind of counterintuitive, there are actually more multi offers that are happening. So that's where more than one person is actually offering on a property. So when there's the right property, and that next point, the cheaper and well presented ones are generally the ones that this is happening to. Realistic people selling and also really well presented, they are actually getting multiple buyers often. And so that is creating an interesting situation where we have prices are, just generally a little bit lower, but then we've got multi offers that are pushing them up a little bit. We're seeing a little bit of higher property selling at auction, which is good as well. I'm still not by any stretch near where we were in 2021, like 2020 and early 21, but yeah, definitely a little bit of an uptick, which is great. And a spring flush is expected, but obviously we still have some economic challenges. So we are expecting more properties to come on the market in spring, and then also more properties to be sold as well. So but there's still those economic challenges. I was having a conversation with some friends the other day about the cost of power, for example, and how much that has gone up in the last 12 months. So there's still some economic challenges, on the ground, and then as a full kind of national economy, we're seeing some challenges as well that we're still working through.
Yeah, and just to compare with say 6 months ago, even more, maybe even 8 months ago, like we sold a property then and we're selling a property now. The difference, very well presented, very similar properties, in slightly different places, but similar properties. The difference in terms of attendance at open homes and the buyers that are available is great, is huge. So we had a couple where there were no attendances at open homes back in February, March, and this weekend just gone, 5 days on the market, 6 groups through each property. So that's a really big change in terms of people who are actually out there in the market wanting to buy. And I think traditionally too, like people get a little bit, well, a bit cold. It's winter, but now we're seeing sort of the flowers come out and the animals get a bit more active, and that's actually hey, spring is on the way, and everyone feels a little bit more optimistic. There's like longer hours, and they get out on the weekend and they look at properties. So definitely hearing a lot more of that out there. So it's going to be really interesting, I think, just referring back to Greg's point, to see what those sales volumes do in the last quarter of 2025, because I think the volumes, kind of that data that comes through, a little bit like with the Reserve Bank, it is looking backwards. So it'll be interesting to see what now data looks like in a couple of months' time, heading into the end of the year, when traditionally people really want to sell their property or buy before Christmas. So yeah, so that's an interesting one. Couple of current trends too. So this is a little bit of a mix of policy and what we're seeing with our clients. So servicing is still improving. So test rates, which you might have heard of before, which is the serviceability test that banks put on when you're applying for a home loan. they are essentially dropping alongside interest rates and the OCR drops, which is actually just meaning there's more people getting approved, more people asking for a certain amount of money, and more people getting the stamp of approval from a bank. And also, I think there's been an increase in people who are actually looking for home loans as well, because they're hearing from their friends and their family, oh, actually, this is a little bit easier than it was. So it definitely is easier. But there is still a little bit of variance across the banks in terms of that service stability piece. So depending on your situation, some banks can be better than others in terms of how much they can actually lend to you in one particular situation. But very broadly, like we're seeing anything from sort of 100 to 200, maybe even more, in additional lending compared to sort of 12 or 18 months ago. So it's a big difference, especially if, people were in that, oh, hey, look, we can't really get to where we want to be. Back then, definitely say, give it another go.
Mm.
Or, hey, couldn't actually get to the purchase of an investment property or a step up. Often it's definitely a lot more doable. DTIs, or the debt to income ratios, which were put in a couple of years ago, have now actually started to become a little bit more relevant. So essentially, that is the amount of borrowing that you can have compared to your existing income. There are some differences with investment properties versus owner occupied, but essentially, those multipliers are now starting to become relevant in that test rates have dropped, which means that there's a ceiling where a DTI is actually going to start to become relevant. So if those test rates keep dropping down, the DTI is going to be the fallback option. So we're almost there with a couple of clients. We have seen that start to come into play, but largely it still isn't having a great deal of impact. Um, Lots and lots of people are either approved for or purchasing first investment properties. So there's two things that have, I think, improved that. So rates, and what I mean by that is interest rates. So interest rates dropping, therefore our yields increasing, and then also tax policy, government tax policy, which has changed back to interest deductibility. It's being phased back in at the moment. I believe that it will be fully in by the 26 to 27 financial year, back to 100%. This current financial year, 75% of your interest expense is deductible, to my knowledge. Accountants can correct me if I'm wrong. Um, Lots of restructuring for tax efficiency going on at the moment. So things like restructuring into companies or trusts, or even just reviewing existing structures, looking at how lending could be made a little bit more consistent, easier to manage, and also like costs of compliance as well. So things like trusts and companies and those sort of more complex structures are just starting to perhaps fall slightly more out of favour. But I think it just depends a little bit on who the solicitor or the advising accountant is. So as always, obviously get that advice directly from your professionals. But we are doing a lot of it, and we are having a lot of conversations with those professionals to make sure that it's right and it's as they want it to be. Lastly, first home buyers still really active, so which is great to see, because I think there's a lot of doom and gloom out there in the media about, oh, investment property purchases are taking over, and they really, I don't think are. There is a bit of competition in some places, but first home buyers are still very active, and particularly those nicely renovated small properties are becoming quite common for first home buyers, where there's not as much work to be done, or it's partially done perhaps, but it's tidy. Those are making really good first homes for people, particularly in the Waikato and the regional areas. So they are still very much active, and we're talking today, it's still a very good time to be buying your first home. I was thinking like back in 2021, yeah, but like a first home purchase for under 650 back then was just unheard of. And now we've got the odd one in the 500, like early 500s, and even we had someone buy for 495 or something last week. So there's definitely some pretty big gains to be had, I think, if we look back and then forward at what might be coming. So yeah, first home buyers have got a really good time of it at the moment, and definitely great to see them succeeding.
Mm. Yeah, absolutely.
Um,
So yeah, I can do this. So yeah, if there's always options in terms of whether what bank you want to look at, how you want to get it structured, what interest rates, all those sorts of things. So we're always happy to have a chat through that. Look at your current situation. Maybe you're on a fixed rate and it's a bit higher, and you're like, what would it look like if I changed? We've had some clients who maybe panic fixed in 2023 at quite a high rate for 4 or 5 years, and maybe now are having a bit of regret. So potentially we can have a look at what that would look like. Yes, there would be some break fees, but it might make sense. And from a cash flow point of view, it might be the best way to go about it.
Mm.
A refinance might be helpful, a whole bunch of things. So feel free to reach out. There's our email addresses. You can also jump onto the website, mymortgage.co.nz. There's an option there to book calls directly into our calendars. So we're more than happy to do that as well. Yeah, love to have a chat, either myself or Claire or Adam or Amber, who are the four advisors at My Mortgage. Be more than happy to do that, and look what we can do as we're heading into that the spring and then Christmas kind of season to get your home loan all sorted for you, or your next steps on the property ladder. So
Mm.
that's all the stuff we had in terms of kind of content to deliver. But if there's any questions, feel free to fire them into the Q&A, and I'm happy to answer them now. In terms of just one other thing that we're seeing a little bit of at the moment, I've probably got 5 or 6 clients looking to do this, is some of that intergenerational living.
Mm.
So parents looking to buy with kids, and looking to help kids into property, but also being able to the kids help the parents as they age and things like that. So definitely a bit of a change, societal change that we're seeing. Parents selling their bigger properties and then doing minor dwellings and things like that with their kids. So yeah, definitely an option, and banks are really open to that. They obviously understand that parents have a
Mm.
slightly shorter time frame to repay the loan, but the kids have a longer time frame, so can make that work there. So that's just one of the things that I've been seeing a little bit of recently, and also we can start to see the green shoots in the build space as well. People
Mm.
looking to get back into that build mode, which has been very, very quiet for probably 2 years.
Mm.
So that's a good thing as well. We've got a whole industry of great tradies that we can now start to get more work for. So
Mm. There's a couple of other things that I'm seeing out there. A lot of requests for sort of partners buying into properties, and also just general change of ownership into trusts or into other entities. And lots of questions around, oh, can so and so use their KiwiSaver because they haven't bought a property before, but can they buy in? And the answer is yes. And we do quite a lot of that. So a lot of someone might have purchased a property 5 or 10 years ago. They've subsequently gotten into a relationship with someone else, and then that person wants to buy into the property. So it doesn't matter that the first person is no longer a first home buyer, as long as the person putting the KiwiSaver in is, then yeah, that is all good. And the other thing that I've seen a little bit of is inquiry about business lending. So I just wanted to say in a really very general way, because every situation is quite different. So let's say, for example, someone wanted to purchase a share in a larger business. They might have been offered shares. The bank will always look at, cool, what is the viability of that overall business? Obviously financials, things like that, but also the equity position of the property, because all mortgage lending is secured by residential property. And for that sort of cheaper interest rate position, which is often why people borrow under that sort of a structure, they have to still do the same sort of checks and balances. So often it's someone who might be coming through the ranks of a business, and they taking in leadership roles and then taking a small share. That is definitely something that can be funded under a residential residential policy. But it does just require the same level of application that you normally have with any kind of purchase. So more than happy to look at that on a case by case scenario, and yeah, seeing quite a bit of it happening at the moment. I think with businesses really starting to try and kind of get things moving, and actually get out there and grow, and also I think bring people through as well. So bring people into the business in a meaningful way and offer them an opportunity. So yeah, so it's a just a really random by the by that we're seeing a bit of at the moment, and might be useful to understand. The one last thing I just wanted to say is we do have an event, Women in Property event, which will be in Hamilton on the 17th of September. Currently finalising a location, and more information will come out on that very shortly. Please do keep an eye on our events page because we pop our webinars on there as well as any in-person events, and we are planning a bigger event in October as well. So please do keep an eye out for that. We'd love to have you as part of it as we grow our team and bring in some wonderful professionals in our network as well to help out. But until then, do we have any questions?
No, there's nothing there. So all
Cool.
good.
Happy
Claire and I will
days.
stay on for a few minutes, and if you've got questions, feel free to fire them into the Q&A or the chat, and we can
Awesome.
answer them. Otherwise, flick us an email. We'll send this webinar out as a recording as well. So if you've got other people that want to see it, then you're welcome to forward that on to them as well. And we look forward to touching base with you at some stage soon.
Cool. Thanks, Tang.
Have a good evening.